Hi, good to see you again. I'm sure you will appreciate another mic.
Oh, thank you.
Hey guys, it's me again. I was here earlier in the day, but for those of you who haven't met me, I'm Catrina. I co-led the Penn blockchain, and also I work at Protocol Labs on the venture growth team where I interact with a lot of VCs and startups within the ecosystem. And today, let's talk about fundraise. First of all, I guess we already know a lot of the speakers here, but why don't we do a round of intro? Let's talk about your firm a little bit, the thesis you recently are monitoring or super interested in, and then what's kind of your pitch to the startup when you try to become my portco? Yeah. Let's start with Toby.
Sure. Thanks for the intro, and pleasure to be here in Berlin. I'm from Munich, so it's nice to be in Germany every once in a while. I just flew in from Singapore. So we run Blockchain Founders Fund, which is an early stage venture capital fund in the blockchain and Web3 space. We do a lot of equity-focused deals. I've now invested in over 100 companies across 5 continents. And when we pitch to our startups, we want to be the most hands-on investor they have on a cap table. That's why we basically have the venture team on our side, which kind of supports our companies with everything they need, from fundraising to press to media, tokenomics, and so on and so forth. And so far, the feedback has been very positive.
Hi, everyone. José here from Delphi Digital. So we have kind of 3 sides to the business. The main one people have heard of probably is research, and then we have a venture fund where we've also invested in over 100 deals. And then we have labs, which is the bit that I'm mostly working on, where we started off consulting, so working very closely with protocols like Aave, Compound, Synthetics, Balancer, Thorchain to help design their token econ and do mechanism design and stuff like that. And now we kind of build protocols from scratch, so Web3 protocols from scratch. Our pitch to protocols we invest in is just that you tap into the entire Delphi hive mind. So there's over 100 people now at Delphi across the 3 divisions. Researchers focused on all different parts of the space, different L1s, different verticals within DeFi, infrastructure, stuff like that. And we also actually have hands-on experience building and like writing smart contracts with billions of dollars of TVL on them. So we bring a lot of like practical and like research experience to projects we can work with. We try and be hands-on when necessary, right? When projects need it, and have been very hands-on with some projects, and with others we're kind of like let them do their thing. Sort of depends on their needs.
Terrific. So yeah, I'm Miko with Gumi Cryptos Capital. So we're a, I guess, 400 million AUM now, but started with a $21 million fund. I think 8 unicorns for there, and for us, we just pitch ourselves as very founder-centric. So from our perspective, we have 3 partners, all of whom have founded and exited startup companies at various scales, including IPO and M&A. So like for us, we really work hard. We're very sympathetic. We understand that Rome wasn't built in a day. So like for us, we just want to help. So I think we've grown our portfolio, and we're a bit of a boutique. So there's only 5 of us, so we're pretty small compared to others. But we do work hard. So hopefully you'll consider us.
No doubt about it. Jason.
Yeah, can you guys hear me all right?
Yep, we can hear you.
Yes.
Awesome, yeah. So my name's Jason. I used to be a general partner at a fund called Spartan Capital. Now I'm helping run Tangent, which is a founder collective of 6 founders in crypto, so all of whom have scaled either billion-dollar protocols or protocols with hundreds of millions in TVL before. So they have scaled things within crypto before, and we found that their advice from having been in the trenches has been incredibly helpful for founders. So we partnered up with these founders, and we all invest our own capital, so no external capital, and we only work with 10 to 12 projects a year in a very hands-on manner to try to get them from 0 to 1. So that's kind of our pitch. We open up one of the most widest networks of founders in crypto for our own portfolio companies, and we limit ourselves to working with a very few number of people.
Awesome. Well, to start off the discussion, let's address the elephant in the room. We all know what happened in the past 2 weeks, and we can call it disruptive, destructive, but really want to hear the panelists' sort of thoughts on what's the impact on the entire adoption of Web3 across the board, and what's the impact on the fundraise going forward. So Jason, I'm gonna put you on the spot because you wrote pretty extensively about this. I would love to get a live version of your tweets.
Yeah, for sure. So I think what happened with FTX doesn't really reflect on crypto as an innovation or as a technology. I think there's a lot of conflation from mainstream media about how the collapse of FTX is a reflection of the crypto industry. But if anything, it's an illustration that we require more transparent systems rather than more opaque ones. Because what FTX was a fraud. It was a fraudulent company that was run incredibly opaquely, that fraudulently stole a customer's money, which is simply not possible in DeFi. So I think time will make sure that people realize that this is actually a cautionary tale for why we need crypto versus the contrary. But in the short term, I think there's an uphill battle to be fought to convince the public that crypto is here to stay, and to really try to disentangle the rest of the crypto innovation and the good work that people are doing from whatever was happening over there at FTX.
Definitely. Is there any silver lining of what we can learn from an experience to look forward and be constructive about it?
Yeah, I think there's a few kind of tangible silver linings besides this growing awareness of the need for DeFi. I think one big thing is proof of reserves for exchanges, right? Before, a lot of people were treating exchanges like their bank accounts, but right now I think there's generally a lot more skepticism. If you look at outflows from exchanges from the week of FTX to now, there's been hundreds of millions of dollars just pouring out of exchanges as people are basically growing more cautious about who they're trusting their money with. So I think recently Vitalik has been putting out some mechanisms for exchanges to potentially do their proof of reserves. I think that's a great first step in the right direction, but I think the next steps would be to also show proof of liabilities, proof of user deposits, to make sure that these companies are run as transparently as a private company can, to prevent kind of these types of systemic blowups again.
Yeah, 100% agree. And all the decentralized infrastructure is still operating as they should, so that's at least the good news. And Miko, I'll turn it to you to talk about sort of the implication of FTX and kind of what you think going forward.
Yeah, so, I think I want to echo the concept that, blockchain did not fail, the technology did not fail, crypto did not fail, self-custody did not fail. Nothing really material failed except for some guy named Sam. So, I really feel like from the implication and silver lining perspective, I think one of the wonderful things that we're getting is that the bear market is a conviction filter, right? And if you think about the conviction filter, like, we're still here and, we're investing on pace. So we invested our Fund 1 into the bear market of 2018, 2019, right? So like that was a great result for us. So like we're here, right? But the other beautiful thing about the bear market is you all are here, right? So like everyone in this room is a high conviction person, right? Because why else would you be here? So like to me, that increases the density, the intelligence, the conviction, the real grounded goodness of the people that we talk to. And there are fewer kind of just quick, get rich quick people, I think crypto is more like don't get poor slowly.
100%.
Yep. So I think one silver lining of FTX is it really shows sort of why we're in crypto. And I saw a good tweet that like, whatever you believe about crypto, FTX thing kind of proves your argument, right? If you think it's all a scam, then you can now point to FTX and say it's all a scam. If you think crypto's about self-custody and freedom, then you realize this just like enhances that point. And obviously I'm bullish crypto, so I'm on the latter side. But what we've seen since FTX is exchanges move to this like proof of reserves thing, right? Where they're trying to prove that at least they have the assets that you've deposited are there. But the problem with that is it doesn't really mean anything without a proof of liabilities, right? Like you can have proof of reserves, and Sam can still be levering up on everywhere else and rehypothecating that collateral, and you don't know actually how much debt is on the balance sheet. And the only way to actually have proof of liabilities, which is what you need the other side of the balance sheet, is via like audits, right, and accounting. And that would not have stopped FTX, right? Like they were committing accounting fraud. He had like a back door. There's actually no way proof of reserves and proof of liabilities could stop what happened on FTX, nor is there a way that regulations could stop that, right? Because regulations don't stop fraud. They just create like a high cost to fraud and a disincentive to it, but you can't actually stop someone from committing fraud if that's what they want to do. The only thing that could stop this was DeFi, right? Because you have live proof of liabilities and proof of reserves. You don't have to wonder how much debt is on the balance sheet. You can see it in real time, right? And that's what we saw throughout this whole thing. Aave, Maker, all the key DeFi primitives survived, and you could see in real time whether or not they were in trouble, whereas the centralized institutions this year have fallen one after the other via lack of transparency, bad risk management, and just like general opaqueness. So for me, proof of reserves is just like a band-aid fix for a problem that can really only be fundamentally fixed by DeFi, and my hope is that FTX can help people realize that.
No, I think I love what you just said. I think that's a very fundamental piece, right? I mean, I also think that this wasn't like a first-time event, right? It wasn't like the first exchange which ever had challenges. And I think it comes down to the risk management piece and the transparency piece, essentially all the things which blockchain and is essentially trying to solve. But I mean, it's also, I don't really fully understand, like, you should have known better. Like for a lot of people in the space, especially funds who went under, where like, as soon as everything goes well, risk management falls under the table and people become careless. And I think also greed takes over to a big point in time. So I think what that basically has shown us is that we are actually on the right track. Like this technology is here to solve exactly those issues. We just have to use them right and have to go back to the basics of what the decentralized aspect means for. And I think that was an eye-opening experience. I do think there'll be a lot more trickle-down effects moving forward. But at the end of the day, it's proving the technology right. And I think and that's a very positive thing under all this, obviously not so positive coincidence.
Yeah, absolutely. That's why we're all here. So now we have FTX out of the way. Let's talk about go forward, what can be most helpful and most tactical for a lot of the founders or prospective founders to fundraise. So why don't we take through the founder's journey, start with the initial pitch. So my question to all of the VC here are twofold. You can pick one of the questions or answer both of them. The first one is, what's your favorite question to ask during these pitch meetings and what you look for when you ask those questions? That's question number one. And number two, what are some of the common mistakes you see founders make? Could be an easy fix, and then we can just help a lot of the prospect builders here. You can answer both, or you can pick one. I will start with José.
Yep. One of my favorite questions to ask founders is sort of why now? So, and it's kind of an offshoot of like the efficient market hypothesis, right? Which is that any opportunity that was a good opportunity should have been taken already, right? And so startups are in a sense like an inefficiency in that, right? You're finding something that no one else has thought of before. But ideally there should be like a reason, some combination of factors that mean that this is only possible to do now where it wasn't possible to do before. And I think what we're looking for in that answer is, first of all, an understanding of like the history of the sector that they're building in, what's come before, what are the trade-offs between the solutions that exist already, why were they built that way, like was there some constraint in the technology, in regulations, in something that led them to be built that way, and what's changed now that people aren't seeing, that you're seeing, that enable this to work. And I think this opens up, like it really shows a founder's conviction as well. Like, for instance, just saying there's this new L1 and we're going to do an AMM on it is not a good enough reason, right? It's not a good enough reason to create a project. You want it ideally to be tailored to this new L1 opens up a design space that isn't possible on Ethereum because Ethereum's too slow, or because there's MEV opportunities to redistribute MEV, or something specific that kind of makes it possible now where it wasn't before? So yeah, that's one question that I like asking.
Yeah, one of the famous things that Mark Andreessen from Andreessen Horowitz says is all entrepreneur pitches are true, subject to business timing, right? So the pitch, of course, they're all going to happen, but the question is when. So I think that's very astute. One of the things I really like to ask is not on the Sequoia template for slides, which is really like what's your motivation? Like, what gets you up in the morning? Like, why are you doing this? You know, why do you care about this? You know, and I really, just to be clear about the question, I'm actually looking for durable motivation. So one of my favorite examples of this actually is Mona from Enzyme, Melonport / Avant-Garde Finance, which is, her story is one where she basically said that she'd had a string of successes in her career, and the hardest time she ever had was actually launching her own fund, right? And her motivation was to make sure that no one had the difficulty in starting a fund that she had, right? So to me, that kind of story is almost like a revenge. It's almost like a revenge story, right? And so if I think about motivations, like that's a very deep, durable motivation. The reason why I think opportunity is not a great motivation is people chase opportunities, and I think you can actually see it sometimes in a LinkedIn background where you'll just see someone chasing the next shiny object one after the other, you know, and in a sense, like, what if it gets hard, right? What if a bear market shows up, which is what's happening right now, right? So if there's an opportunity chaser in your portfolio, they're just going to leave. They're going to go chase whatever is happening now.
Yeah, and that's actually my favorite question to ask as well, because also screening out those solutions in search of a problem. I have an interesting tech, I just want to do something with it. Like, so if they really don't have a coherent answer to that, that's also a definitive, I wouldn't say definitive sign, but it's a pretty good signal of it could be a solution in search of a problem. Toby.
Yeah, I think for us it's extremely important how precise answers are being on a call. Right? For example, if someone tells you what's your go-to-market strategy, and you have to actually, and probably also think through this, like how many precise answers have you actually gotten? Right? Because a lot of people are going to tell you, I'm using word of mouth, influencer, I'm building a community, but like how? Like how do you build a community? Oh yeah, I'm going to get like, you know, doing like thought leadership. Like how? What are you going to talk about? Like how detailed can you go until a founder just doesn't have an answer anymore? And obviously in a way that it's constructive, because not every problem I get and not everything is thought through at the moment, but that's also like where your investors should be supporting, right? But in a sense that like you as a founder should really think this through and go a lot deeper than just having these fluff answers, right? And like I think it's also a quality of what every founder should assess the venture capital fund, of like how deep are they going, how excited are they to understand your business. Now in terms of the one question I like to ask is kind of like, why should you be in that market? Like what's justifying your business to be successful in the market? And that's always a quite interesting way of understanding if you're building something, is it a little bit better or is it like substantially better? Right, because very few customers are going to do something different if it's just a little bit better. They need something which is substantially better, or maybe even completely different at all, and changes something we have been doing in the past. And I think a very interesting point of evaluation, what I always tell to our team, if you're talking to a founding team or to a company, and you don't want to jump ship and leave our fund right now and join them because this is going to be the next unicorn and you're going to be a billionaire, I'm not sure if you're actually 100% convinced that this is the right company. Or even vice versa, if you don't want to hire the founder because he's such an instrumental part and could be such a value add for our fund, like, are we investing in the right team, or are we just investing in a good business model with having like a good team but not a fantastic team, right? So I think there's a lot of different ways of looking at it, but I think it bears down to like really deeply understand the details of how things are functioning, and building a good relationship with the founder of understanding the cause and his motivation of understanding why this business will be successful, even in a market when you might have to be operating on fewer resources, have to be more resourceful on how to operate a company, and not everything will be as exciting because it's just going to be more of a desert road than it is in a bull market.
Absolutely. Jason, any insights?
Yeah, I think I agree with most of what was already proposed. I think for me, the main point of the calls is really to get to know the founders on a personal level and really try to understand the founder market fit, right? So I don't care as much about the product market fit because the first version of the product rarely is the one that kind of it rarely resembles the version that actually takes off. I think what's more important is kind of understanding why the founder is like uniquely positioned to solve a specific problem. So to that end, I think a few questions that I usually ask is, for instance, for the founder to walk me through all the historical solutions to the problem they're trying to solve and why they didn't work or what the shortcomings are. So that usually gives you a sense of how big the opportunity is. Like, is this a marginal improvement or is there a massive kind of hidden opportunity and unique insight that this founder has? I think the other question that I ask is, who are your first 100 users? Because founders usually would give you incredibly ambitious projections about the first million users or 2 million daily active users, but once you force them to really think about who are the first, say, like dozen or 100 people that you actually call to see if they use your product, it forces them to be very upfront and clear about what their go-to-market strategy is and how deeply they understand what is who are the people they're actually targeting. So I think those two, leave it at those two for now.
All right, and looks like no one wants to talk about the mistake, or did I miss it? I can share one. It doesn't apply to everyone, but I do feel like a lot of VC like to ask questions. And one common, I wouldn't say pitfall, but I think could have gone better is if I listen to 20 minutes of founders straight out talking about pitch, if I were the founder, I would have paused after 5 minutes, just be like, did I lose him? Like, what are the questions? Because VCs, like, I assure you, and keep me honest here, we like to ask a lot of questions because we actually have a lot of the framework to evaluate business. So just make sure whenever you pitch, you leave enough time for the other side to engage and actually make it interactive. Any comments there?
Yes, I want to give you an easy thing and a hard thing. So the easy thing is when you do your cover slide, just put the name of what your thing is, right? And don't put anything else on there. Like I promise you, it's a good idea. And the reason why is VCs have crazy overactive brains. And if you put some kind of description of what it is, like you're like, oh, it's decentralized Uber, or whatever you put on there, it's going to be a hopelessly bad explanation of what you are. And the VC is instantly going to think of 3,000 reasons why they don't want to invest in what they think your company now is, right? So just cover slide, name of your thing, that's it. If you want to put your name there and your title, that's also good. But don't say what it is. Leave that for the deck. That's the easy one. I have a hard one.
Okay.
The hard one I have is particularly targeted at European startup companies, which is trim down your team slide. Like, we're early stage investors. We like to see a team slide where it's like, there's product, there's engineering, we're done. 2 people, right? We like that. We don't like a team slide that takes 4 slides and has 60 people on it. Like, that won't work. Like, and the defense of none of them are getting paid doesn't work either. So, that's my critical feedback is huge teams, dislike. Big burn rate, not good.
Love it. So, how candid. Really appreciate the tips here. Okay, the next topic is on valuation. And that probably comes up as about to have a term sheet or kind of in the middle of the pitch. Especially given the market, valuation from now compared to 6 months ago, it has changed a lot. And especially for first-time founders, how do they know how much their company is worth? And exactly like where do they find those information?
So this is an easy one, which is your company is 100% worth fair market value, right? And what that means is it's worth whatever the highest bidder will pay, and that's it. And there's no other place that you can look it up, and so don't try.
So in that case, there are usually two ways I see it. As a startup, what's the valuation you're targeting? So they either give you something or tell you, I'll let the lead decide. So which way is actually more recommended? Should I give an anchor for them to work around that, or I would just say, whatever, you guys decide?
I think a quick thing here is like, it depends what stage you're talking about, right? Because if it is a pre-seed round, then there won't be an anchor. We don't need an anchor. We don't need a price round. We just do a valuation cap and a safe and like move on. But it's like, if it's a later stage round and you're looking to actually get a price round to have all your safes convert, then it's a very different story, right? Because then, but that makes the whole thing a lot more complicated in the first place. But I think founders are worrying way too much at a pre-seed level for the valuation piece. I think the whole point is like, ideally you want to get some good people on your cap table, you want to get money in the bank and start building, and essentially move towards which is more substantially towards measure valuation on. Right? So most of the time when we try to find founders before they even start raising, there is nothing, right? I mean, like, and then you just come up with a valuation cap, and let's say 10 million, 8 million, depends on, previous companies you have seen, and then essentially try to go for it. You get $500K to $1 million in your business and build on it, act on it, and move forward, right? So I think how much time do you need at a pre-seed company to figure out evaluation if there's easier ways of just moving on and getting towards actually building something where then someone can evaluate your company on?
I have a hot tip, which is I don't want to comment very specifically on current price action because that's definitely going to change, right? But what I do recommend is this, is if you're going to get an advisor on VCs, get an advisor that is a VC. Do not get an advisor on VCs that is not a VC, because they generally have no clue and they'll lead you in completely ridiculous directions. But the thing that's interesting about this is why would a VC advise you on VCs? Well, it turns out this. In Silicon Valley, we have a saying, ask for advice, get money. Ask for money, get advice, right? So like, you should definitely talk to VCs and have one, helping you raise your round.
Getting some life lessons here. Jason, what about you? I know you have more of an early stage, very hands-on builder model. How do you advise your startups on valuation?
Yeah, I think there is a temporary structural issue with venture in crypto right now. Basically, a lot of funds over-raised, right? It was way too easy to raise for funds in Q4 to 2020, up to Q4 of 2021. So there's a massive amount of earmarked venture money that has to invest in proprietary deal flow. So they can't go on secondary markets to buy, but development has slowed down definitely relative to the highs of the market. So the number of deals, the quality teams have gone down. But the amount of money that has to be deployed within 3-4 years so that the VCs can keep raising their next funds is still here. So there's a lot of pressure to deploy. And as a result, a lot of VCs are pushing early stage founders to raise at very high valuation so that they can write them bigger checks in order for them to deploy their funds fully. So what this leads to is for your next round, which for Series A, for instance, you require some metrics to justify a higher valuation. Because it's a bear market, a lot of these companies might not be able to justify that, so they're probably forced to raise at a lower valuation. And if they do have a token and they come to market, a lot of these projects that raise at a pre-market valuation of say like $500 million before there is a product, they come to market, there's no secondary market to support that. Token price tanks, that hurts community morale, it hurts treasury and so on. So I think that is the biggest problem that I see with venture money in crypto right now. I do think it's temporary because I do think that might be unpopular opinion, but I do think that returns in venture for crypto is being crowded out, and the appetite from institutional allocators will probably lessen over the next few years. So I think we will eventually mean revert. But I guess in that context, for founders that are raising money right now, it's tempting to raise as much as possible, and there are a lot of VCs that will be very eager to kind of way overpay for companies. But I would really advise founders to really think about strategically, think beyond just the current round, right? Think about what you want to do in the next 5-10 years of your company, and position yourself that way instead of burning all your cards in the very first round.
Yeah, absolutely. It's a marathon. Jose.
Yeah, no, I'd agree with that. I also think raising the minimum possible to get you to the next milestone is almost always the right approach. You got to think, if you're going to be doing this for 5-10 years, and if you're doing the startup in the first place, it's because you think it's going to be more valuable over time, right? So the point at which you're raising, especially at the early stage, is actually like the point at which your company is least valuable. So you want to raise enough to get you to sort of the next milestone where you'll be able to raise at a higher valuation, but no more, right? And it's kind of a red flag if projects are trying to raise a lot of money up front, because what you're saying is, this is as valuable as I'll ever be, right? I'm trying to cash in on my current value at the earliest stage, which is the opposite signal of what you want as an investor. So it's like, think carefully about like your roadmap, what the milestones are that you want to hit at different times, and how that will increase your value or de-risk your project in the eyes of investors, and then raise enough to get you there, which also enforces like discipline, that you actually have to hit your targets because you don't have like endless runway, right? And I think there are a lot of examples in startups of raising too much money actually like killing a company, because it just means you don't need to have any discipline, any product discipline, any hiring discipline or anything like that.
Absolutely. Well, moving along the journey, so now you invest in early stage, and usually when it's super early, you sign a safe plus a token warrant. And later, as a startup founder, you gotta decide, do I want to tokenize or no? So this might be a difficult question. So I'll have a backup question for you if you don't like, answer a different one. But is there any hard and fast rule to determine whether a token makes sense for your business? Answer can be, if your like marketplace model doesn't make sense, that's kind of answer you can resort to. Or the backup question is actually going forward with the regulatory environment as it pertains to token. Does that change your advice on whether you should or should not tokenize, and what are the considerations? So you can pick one of the two questions to answer.
Yeah, I'm happy to take a crack at it. So for us, we are definitely neutral. I think the safe with the token warrant structure actually is fairly protective. The thing that we really dislike is we dislike one group that has tokens and a different group that has equity. Like, we just think that's a recipe for misalignment and for like basically destroying your company. So like, we definitely dislike misalignment. So we really want to have one kind of, person that's in the same boat. So, I would say those are the caveats. But with respect to kind of like, should you tokenize, we're still believers in the token thesis. From our perspective, it really more has to do with logical value capture. So if the value is logically captured in a token, then by all means.
Yeah, I would agree. I think I definitely agree with the alignment point. I think that's a big red flag if you have equity holders and token holders, especially because shareholders obviously have like legally enforced rights with 80 years of case history backing them up, whereas token holders have none of that. So if it comes to a battle, token holders are always going to lose out. In terms of doing a token, from a regulatory perspective, the rule, the kind of, and we build projects that have tokens, so we've kind of thought about this a lot. I think that the general rule of thumb is, if there is like a point in the future where your team could credibly all retire and go to the Bahamas, and your project or protocol would run and be governed by token holders, then you should do a token. Otherwise, it's likely to be a security. Like, if this thing is going to be dependent on you forever to like have an app on the App Store, or to have for-profit companies that interact with the real world to do fiat payments or whatever, then it's very likely not going to be it's very likely going to end up being a security, right? Because it's kind of reliant on your efforts. So I think there really needs to be at least a roadmap to decentralization and to full decentralization of kind of all the different parts of the project. So like front end, back end, smart contracts, like all your interactions with the real world, all that kind of stuff for a token to make sense. And then in terms of launching a token, like, you got to realize at the point you launch a token, it's going to take up maybe like between 40 and 60% of your time is managing like token related things, whether it's like doing herding for governance votes, or answering questions from angry token holders on Discord, or dealing with when moon kind of stuff. Like, that is going to take up a lot of your time, and legal side of it, listing on exchanges, all that kind of thing. So I really only recommend doing it if you have, first of all, a regulatory reason to do it, or like where you have smart contracts and someone needs to govern them, and you don't want to have an admin key or a multi-sig, so you need to pass it over to token. Or your product is at a stage where you can afford to spend half of your time dealing with decentralized governance, right? And not actually building the product, because it's going to take up that much time. So yeah, that's some thoughts there.
But I do think we need to probably look even one more step in front, which is kind of like understanding why there is even a need for a token, right? Despite obviously that it adds a lot of different layers of complexity towards a business, and also in terms of time, I think we need to be a lot more critical of like what is the actual benefit for the business of having a token in the first place, right? Not every company in the blockchain space needs a token, right? And I think that's also something which needs to be thought through way more critical. For example, like in the B2B side, I haven't seen a lot of very successful tokens, right? Is that something because it's generally flawed in the economy, or is it maybe not the right suitable fit? Is it more like better beneficial for like community-driven aspects on the B2C side? And then even if it's there, like is it just a way of like inflating the business, or because it's a hype sort of situation, or what is the actual utility of the token for your users, and why does it make them better, stronger, or faster, or whatever, using the business you're building, right? So I think that there needs to be a thorough evaluation if there is a need for it, or if there's actually deep down no need for it.
Yeah, and I think just to add to that, I think with the cyclicality of crypto markets, even back in 2018, I think there was a huge aversion to tokens, and a lot of funds became just equity only. And then obviously when 2020 came around and tokens started rallying, all the funds pivoted back to tokens. So I think entrepreneurs' openness to tokens kind of followed the market. You didn't really need to give too much thought to why you need a token back in DeFi summer when everything had a token. But right now, what we're seeing is a lot of founders are being a lot more disciplined about thinking about how the token actually could add value or actually take away value from a project. So I don't want to name the specific project, but there is a B2B, pretty popular B2B infrastructure product in crypto that has very, very significant backing. And they decided to issue a token which actually didn't perform so well. So now it's actually materially impacting how they can raise for the next round, when in fact their product works just fine without the token. Now at the same time, I do think that I'd say 99% of the things that are interesting in crypto have to do with tokens. Because in my opinion, if we're not backing decentralized networks, why are we in this space in the first place, right? So we do have a strong predilection for tokens. But the types of tokens that we don't like are very Web 2 heavy products that are just using tokens as reward mechanisms, right? So they're basically just printing the tokens as a form of virtual money to reward users, to onboard them. So it could be a pretty effective go-to-market strategy and bootstrapping mechanism, but if that's the only use case for the token in the long term, then it's not that interesting. I think where tokens are really, really interesting are if it's used to actually coordinate efforts. So I think there's whole pieces around like proof of physical work, for instance. You see it with like networks like Helium and Filecoin, where people who are performing functions to support a network or a product are paid in that tokens, and they actually require it's required that they have those tokens to perform set actions. So it's kind of like a abstraction of what we are used to with like BTC miners and Ethereum miners. But to me, the core question is, okay, how do we kind of abstract that idea with miners and stakers to like the product level? And that's where we see most of the actually interesting use cases for tokens.
Awesome. Wow. Thanks for the insights. This is great. Hope all of you are learning something as well. And the last question, actually the last two questions I have to let everyone take some insights away, additional insights away, is what are the most exciting areas you're monitoring, whether sector or use cases, basically the next wave of adoption, what will enable it? Or you can pick the other question of what's the biggest piece of advice you have to all founders out there in Web3 right now?
I didn't quite hear the second part, but the first part is about sectors. So, one of the things that we really think is exciting is actually the gaming sector. From our perspective, we think that institutional financial adoption is not going to give us the next leg up, right? I think that, that one got exploded, over the past few weeks, right? So the question becomes, what's the catalyst? What's the catalyst? And I think the catalyst is going to be bringing on another billion users coming over from the game sector. So I still have optimism about sort of the gaming sector as being an interesting one for producing the next leg up.
You ready, Jose?
Yeah, I mean, I definitely agree with on the gaming side. We've done a lot of stuff in gaming, and I think it's one of the most exciting kind of sectors in crypto. And you've seen over the last 2 years, there's been multiple billions of dollars invested in Web3 gaming. And we've spoken to some founders who are sort of like OGs from the gaming industry. Everything from like League of Legends founders to EVE Online founders to some of the biggest games that are successful in Web2 that are now building Web3 games. So I think over the next 2 to 3 years, there's going to be like a whole slew of just like really cool Web3 game experiments coming online. And I think we don't know what that looks like yet. Like there's people experimenting at all edges of the design space, right? There's like fully on-chain games. There's games where only the assets are on-chain and most of the logic happens off-chain and sort of everything in between. Games that are like just normal games with a crypto element. Games that are entirely built around crypto and market elements. So it's going to be really exciting to see. But in general, I think it's like all the same sectors that have always been exciting are still exciting to me. Like I think DeFi is still super exciting. Like if we think that, I think for crypto to succeed, DeFi needs to succeed. I don't really see a world where that doesn't happen. And so like a decentralized, global, permissionless, open financial system is still like one of the biggest opportunities in crypto and in investing generally in my mind. And I think the FTX thing and all the centralized counterparty failures this year only sort of increase that for DeFi, right? They only make the use case more clear. And I think over the next 24 months, we're going to finally see experiences that are like comparable to centralized exchanges on like execution and liquidity and asset choice and all of that. So that's going to be really exciting. MEV is super cool. There's a lot of cool stuff happening in MEV. And then I'd say like, in general, the approach I take is kind of, if you think about 5 years from now, in like a crypto utopia, or 5-10 years from now, what does the world look like, right? What does decentralized governance look like? What does DeFi look like? And what needs to be built for that to be the case, right? And I think one of the areas that's most lacking is governance tooling, right? Like it's a huge cost launching a token because you have to coordinate this herd of token holders to vote on every single decision. I think it's pretty clear that's not going to be the end game, right? Like everyone, imagine if in a company or in a state, everyone voted on every single decision. Like you just wouldn't get anything done, right? You have delegation of decision-making power for a reason. You want specialists in their areas to make decisions in those areas. And the same thing is going to happen in crypto, and all the tooling needs to be built around that. So yeah, I think all the same areas that have always been exciting about Web3 are still super exciting to me.
Yeah, I think to add on to this, what I'm also quite excited about is the whole like social aspect of crypto. Like ideally something where we can bring in a lot of users very quickly in the space. I think that's also how gaming is a very exciting aspect. But like, I mean, a lot of people are already spending so much time on social media and like all these socials. Like how can we create a better platform where you can get rewarded? I mean, there's obviously certain challenges with it, but that's a big adoption curve at a very low hanging fruit if of course we build an infrastructure which can handle that. That brings me sort of to my second point, which is the whole developer tool space, right? Because I do think we need to build a lot more interoperable, exciting, easy to use infrastructure, not the layer ones and layer twos. I'm talking about more like, how can we get a lot more developers in the space who are like building awesome stuff, and how can we make it easier for them to get acquainted? And I think that's why it's so hard to pinpoint one specific industry, because if gaming won't always succeed if it's easy for people to build in the space and if it's easy for people to access the space, right? So it's a bit of a joint aspect, but I do think that gaming, social, dev tooling, and it's also the securities piece of like how can we secure facts more easily, better, faster. I think it's one of the 4 areas which I find quite exciting right now.
Yeah, I think the panel pretty much covers most of the kind of application layer things that we're interested in. So I guess just to touch on also on the infrastructure level things as well. I think there's still a lot of open problems that could be solved or things that could be massively optimized. Like for instance, maybe data query and indexing. Is there a better way to do that than like how the graph does it? For instance, the Oracle problem. Is there a better way to bring on-chain, off-chain data than how Chainlink is doing it? And then I think the core idea of what a blockchain is probably also going to be challenged, whereas before a lot of people thought, okay, let's just deploy our contracts on Ethereum or deploy on Solana or on this or that blockchain. People seem to be rethinking about what a blockchain could be. What if we strip out the data availability layer and make blockchains modular? Right? What does that imply about the FAT protocol thesis? I think these are all extremely interesting questions. And some ecosystems that we're watching is, for instance, like Cosmos, where applications are verticalizing into their own L1s. So why can't we have like thematic app chains, for instance, where you just have one chain that's only for a specific use case? And then we are starting to see companies that offer like rollup as a service as well. So why can't every application be its own rollup and just use like Ethereum as a settlement layer? So I think all those kind of open questions in terms of how centralized applications will be built and just how different they will be from Web2 applications will be answered in the coming 3-4 years. And those are things that we're definitely keeping a very keen eye on.
Awesome. Now we also come to full circle because this morning we talked about app chain versus monolithic design as well. And with that, that's it for the VC panel. Hopefully that was helpful to you. And thank you, panelists, for coming. That was productive, informative. I love it.
Thanks for moderating.
Thank you very much.
Thank you.
Thank you so much.